This is Raul, and I am here to present to you what I feel is the best long term investment. The investment that I'm going to be speaking about is the only thing that I invest in currently, and I find that it is an investment that will bring you peace in the short term. And what I mean by that is that I've seen a lot of people have now gotten into day trading stocks on Robinhood, and they're stressed out all the time. They're trying to find good deals. They're doing all this research. They sometimes they make bad calls and they're mad at at themselves. And this investment will bring none of that. This investment that I'm going to be talking about, you just contribute to it, and it will, and there's nothing to think about. It will do its job, and in the long run you will do well. Another thing that I like about this investment is that not only will it bring you peace in the short term, it will also bring you peace in the long term. And what I mean by that is that you don't have to change your strategy depending on if the world changes, right? If the U.S. maintains its status as the top economic power, you do well. If we have another country like China or India that becomes the next leader, you do well. If big tech, you know, it doesn't matter what happens to big tech. If green energy becomes the next big dominant, industry, it does not matter. This investment will do well no matter what country, no matter what sector of the economy is dominant in the future. You will do well. So my agenda for this little mini presentation. First, I'm going to tell you what this investment is. Then I'm going to go into its composition, what is in it. Then I'll go over a list of reasons why I like it so much. And then a few words of caution, because no investment is perfect for every situation. So there are some times when this investment might not be appropriate. So I just want to speak to that. And then I will wrap things up with just equivalents. Basically, like if you don't have this investment available to you, some ways that you can maybe get access to this kind of strategy. And yeah, so that's pretty much my little agenda. So let's get to it. The best long-term investment, in my opinion, is the Total World Stock Index Fund. And more specifically, the Vanguard Total World Stock Fund, which is VTWAX. This is the ticker symbol. And this is a Vanguard fund. It has a minimum investment of 3,000. And this is what I invest in inside of my Roth IRA. Now, if you don't invest with Vanguard, or if you don't have $3,000 to invest, you can use the ETF version. So Vanguard has an ETF version of this fund, and an ETF stands for Exchange Traded Fund, and it trades a lot like a stock. And so if you're on a platform where you can trade stocks, you can also access the ETF, and a lot of those platforms will even have free ETF trades. So VT is the ticker symbol for the ETF version. I believe the current price is about $80. So for $80 for $80 you can get a share of the ETF version of this fund. And this fund is an index fund, so that means it doesn't try to beat the market. It tries to just match the market. And the market that it's trying to match or track is the FTSE Global All Cap Index. So this is basically a index of all of the companies in the world. And that brings me to my next slide, the composition of the Vanguard Total World Stock Index. So it's an index of 8,682 global corporations. So that's a lot. And the reason that's such a large number is because this fund tries to have almost every major corporation in the world. And so and when I say the world, I mean, North America, developed international. So these are international countries that are fully developed, and emerging countries as well. So these are countries like the BRICS, they call them sometimes: Brazil, Russia, India, China, and South Africa. So, and there's a few other countries that are grouped in there with other emerging countries. And right here you see a little table. I got this right from the Vanguard website. So you can see kind of how that money is distributed. So 60% of that is in North American companies. So, and that's mostly US, so you know who those companies are, right? The Amazon, Apple, McDonald's, Disney. So that's all in here. And then we have about 30% developed international and like a little bit more than 10% emerging markets. And over here we have a table of all the countries represented. So, so lots of countries there. So when you buy this fund, you're investing in countries in Austria and New Zealand, in Italy, all over the world. Another thing I like about this fund is that it doesn't just have the big giant companies. It has medium companies. So 70% is the large companies, and then 20% is medium, and about 10% are small cap companies. So those are smaller companies. Smaller companies tend to have higher potential for growth, but they're also a little more risky. All right, so that's what's in this fund. Now, why do I like it so much? First, this fund is all stocks, sometimes known as equities. And I believe that over the long term, stocks are the best investment. They have historically a high return around 10%. And 10% might not seem high to you, especially to a lot of you day traders who are trying to get, much higher than that. But I'll talk about why that's kind of a losing cause. But I also don't want you to downplay what 10% means. And this little presentation is not about compounding interest, but go find the compound interest calculator and put in 10%, and then put in how much you think you can afford to invest, and you'll be shocked at how much money will grow when it's compounded at 10%. We're talking about, if you start when you're 18 and you're putting in 100, a month, just 100 a month, $25 a week, you're going to be a millionaire by the time you retire. And a lot of you can do more than 100 a month, so you're going to be a multimillionaire if you start, when you're 18, because that's a really important part of investing. And if you're not 18, don't let that, discourage you. Compounding will help you if you're only investing for 10 years, whatever many years. All right, so equities. I love equities. I think it's the best long-term investment. I think it's better than bonds long-term. I think it's better than precious metals, right? A lot of people are always hyping gold. I think equities are better than gold long-term. I think it's better than a lot of people have gotten into currency, especially cryptocurrencies. These are companies you're buying. They produce things, they produce items, they own patents, they own real estate, and you're buying that. When you buy a share, you're buying into all that. So I like equities. I also like low fees, and these are Vanguard funds. So Vanguard, everything Vanguard is cheap, and so for the VTWAX, the mutual fund, you have a 0.10 expense ratio, and what that means is for every $100, you're going to be paying 10 cents in expenses, which is very cheap for such a diverse portfolio, and it's even cheaper for the ETF. All right, so for every $100, it's going to cost you 8 cents in expenses, and again, compound interest, right? That this is a big deal. Low fees. You might think, oh, if I have to pay 50 cents in fees for every $100, that's nothing. But again, go to the compound interest calculator. It really adds up. So you want low fees. So, we're investing in stocks, which I love. We got low fees. All right. Now you might be saying, but wait, I already buy stocks. I can buy stocks. Why buy this index fund? Why pay any expense ratio? Why not just buy the companies that I like? And the problem with that is risk, right? The expected return of any stock is roughly the same as the whole market. That's the expected return, right? But the risk is much higher because a company can go bankrupt, right? 8,000 companies are not going bankrupt. If all these companies go bankrupt, you have much bigger problems than your investment portfolio. It means like the apocalypse has started. So, this is this is a lot less risky. Individual stocks are much more risky, not to mention the fact that, well, think about what you're really saying when you buy an individual stock, right? Stocks are sold on a public market, and you have some of the smartest people in the world trying to find undervalued stocks. For you to buy a stock, it's you saying that you think that stock is undervalued and that other people don't know that. Now, do you really think that you can pick stocks better than the total of everybody else, everyone else together versus you, and you think you're gonna beat them consistently, is not happening, right? In fact, not only do I think like you can't do it, and I'm sorry if that sounds really mean. I really don't think anybody can really do that consistently, or at least I wouldn't bet on it. So again, index funds, you get high return, much less risk than individual stocks. Now, index funds versus actively managed funds. So, actively managed funds are basically these stocks being picked, but this time they're not being picked by Joe Schmo, they're picked by a fund manager. Now, I'm sure these people are really smart. They have big teams of of people working under them. They might have special custom software and supercomputers looking for undervalued stocks. But again, if you go look at the research, these actively managed funds consistently fail to even match the index. And especially after you consider the fact that their expense ratios are a lot higher than an index fund because all of that research and all that manpower costs money. So index funds historically have performed better than actively managed funds. Another reason why I like this investment is the international exposure that it has. It's become really trendy. Index funds are actually pretty popular now. But one thing that's kind of bothered me a little bit is that you'll see a lot of people just touting just US based index funds like the S&P 500 or even the total US stock market. And I know why they're doing it. The U.S. stock market has been on a run for a while, and for over a decade, the U.S. stocks have outperformed international. But throughout history, there have been long periods where international has surpassed U.S. stocks, and I just don't see any reason why I should invest in Ford and Tesla but ignore Toyota and Mercedes, right? So I think it's foolish to discount international, especially because U.S. stocks are actually they're valued pretty high, right? There's something called valuation, different ways to measure how much how what's the price of a company, and U.S. companies are are pricey right now with respect to what they earn. Um, that's not to say I think they're a bad investment, but it's just that can't continue forever. And so, yes, it has international exposure. So you get to own Samsung, Nestle, Toyota, Alibaba, Mercedes, all these other international companies that I think I want those in my portfolio. I don't know if Toyota is gonna, maybe Toyota will buy Tesla. Maybe Toyota will make the electric car that beats Tesla. I want a part of that. All right. Finally, you're not making bets on anyone. You're not betting on any company, on any country. You're buying everybody. The only thing you're really betting on is humanity. Humanity getting wealthier. And I feel actually pretty good about that bet. If you ever look at a stock market chart, it's up and down, really jaggy. But go look at a chart of world like wealth, like world, GDP or something. You'll see that chart is very steadily goes up because right now, in India and China, there are millions of people that are rising out of poverty, and they are where America was several decades ago, and they're buying cars for the first time, computers, smartphones for the first time, and I don't know if those phones are going to be Samsung or Apple, but I know they're going to be buying them, and by buying this fund, you will participate in that economy and that wealth that gets generated. So so this is why I really like this fund and this strategy. Now, some caution, right? This fund is 100% stocks, right? 100% equities. And again, I don't think it's risky because you're not betting on one company, you're betting on many, but it is volatile, which means that stocks, we can go through a worldwide, depression or recession, and this fund could be down for several years in a row. Long term, it's going to do around 10%. But you could go through a 5 year period, you could go through a 10 year period where it stays flat or even goes down a bit. So this is not the type of investment that you would like if you have a kid who's 15, they're going to go off to college in a few years. This is not a good investment for that situation because you don't want to take the risk that you will have a big loss in 2 or 3 years from now. This is ideal for the accumulation phase. So when you're stacking that money up, right, through your working years, this investment is ideal. I don't think it's ideal for the withdrawal phase, right? And maybe I should write that right there. Ideal for the accumulation phase, not for the withdrawal phase. So withdrawal phase is like once you hit retirement and you're taking money out of the investment. And the reason it's not ideal for that is because again, it has to do with the volatility. If you're taking out your living expenses out of your nest egg and the economy has a big drop, that percentage that you're going to be taking out is going to become a lot larger because your nest egg has gotten a lot smaller. So this can definitely be part of your retirement funds, but you need some bonds. Bonds are what smooth out that volatility. So you could do like 60% total world, index fund, and then 40% total bond market, and then you're good. But what I wouldn't do this 100% for the accumulation phase, except for if you have a really really large nest egg where you can live off of like 1% of it or something like that, then yeah, this might be good. This will definitely maximize how much you will leave for your as an inheritance. So yeah, so if you have a really large sum of money, I think this is good. But for most people, once you hit retirement, you need some bonds in your portfolio. And then the other thing I would like to say is, even though this isn't crazy advice, this is not some, I'm not telling you to go put all your money in Bitcoin or to invest in penny stocks or something crazy like that. It's probably in one respect, it's a little different than what the mainstream would say, and it has to do with this over here. I think like a mainstream strategy would be about 75% or 70% U.S. stocks and 30% international total. This strategy is a little bit more towards the international side, and I get again, it has to do with me just not wanting to make bets on anybody, right? Even though I love my country, I love this country that I grew up in. I don't know what the future holds. I'd rather just bet on everybody. So it's not exactly what you would see most commonly out there, though there definitely are people that agree with this strategy, and I think most investment people would say I'm reasonable, even if they disagree with my choice. All right, equivalents. So Vanguard flavors. So the Vanguard version of this fund, VTWAX, I invest in this in my Roth IRA. Now, again, you have the ETF version. This should be available to most of you, no matter what platform you're using. Um, and you can also find other ones. Now, any index fund that tracks the FTSE Global All Cap Index will work. Just look at that expense ratio. Now, if you remember, this fund has an expense ratio of 0.10. So you don't want to go much higher than that. Um, so, just make sure it's cheap. Now, I did look real quick and I didn't see an equivalent from Fidelity or Schwab, which are the two that I usually check first. And just because I used to use Schwab and my mom uses Fidelity and I help her with her investments, and I didn't really see it there. Now, you can also make your own, right? And I actually have to do this in my 403b because I don't have, all world, total world index in my 403b. So I'm just kind of doing a rough approximation. I have 45% S&P 500 in that fund, 10% small cap US, and then 45% international. So that's roughly the equivalent to this. Um, so yeah, so you can make your own if you want, but I really do prefer the all-in-one thing. The all-in-one, you don't have to worry about any percentages or anything like that. You just put your money in and watch it grow. So that's pretty much it. So the Vanguard Total World Stock Index, I love this fund, and hopefully some of you guys stop all your crazy research and realize that investing can be simple and efficient, and this is one way to go about doing that. So thank you for listening. Have a good day.